Well, good morning, everybody. My name's Buchanan. I'm a financial planning partner based out of our Colchester office. Now, normally when we prepare the night before, we get really excited about being able to stand up here and talk about all the exciting changes that have taken place. Well, actually this year, what I'm quite excited about is to talk about some of the things that haven't changed, which is a bit of a change from the normal procedure. In particular, pensions. It was widely expected that the Chancellor would look to attack pensions and raise some tax by restricting some relief on pensions, but I'm pleased to say that wasn't the case. So let's just remind ourselves about how important pensions are in financial planning. Down the left-hand side of this chart, you can see the tax relief that's given on the way into a pension plan, starting at 20 and going up to 60%. Now that 60% applies to anyone who's making contributions and earning between £100,000 and £120,000. And anyone who is in that bracket can achieve 60% tax break on making a pension contribution. And if you look into the main body of that table, what you see is that most people, when they're working, will pay a higher rate of tax than they will when they extract money from their pensions in retirement. And that further adds to the effective tax relief and the value of making a pension contribution when you get into retirement. So we absolutely see this as a big bonus, because we expected restrictions to be made on making pension contributions. That hasn't happened. And I think the message really is we should be using these things before they do get removed in the future. It was also widely anticipated that they would restrict the amount that you can pay into a pension, which is called the annual allowance. Now, the annual allowance for the tax year of 18-19 remains at £40,000, the same as it is in this financial year. Now, to make a pension contribution of £40,000, you do need to have relevant earnings of £40,000. Therefore, if you're only earning £20,000, then the pension contribution is restricted to £20,000. If you're a higher earner, further restrictions do apply. So if you're into paying additional rates of tax, that £40,000 contribution can be tapered down to £10,000. And a word of caution, if anyone is receiving income from the pensions, that £10,000 can be reduced further to £4,000. There is an ability to carry forward unused allowances. So if you haven't maximised your pension contributions in previous years, you can carry those allowances forward and make a contribution of up to £160,000 in this financial year. Again, going back to the start, we expected these things to be changed, so I would urge people to consider doing that if it is appropriate. I mentioned relevant earnings. Relevant earnings apply if you're making a personal contribution. You have to have earnings of that level to justify the contribution. If you're working in a business can make a pension contribution for you, and slightly different rules apply there. So again, anyone who's employed in a business and has the ability to facilitate a company contribution, it is worth thinking about. And again, salary sacrifice remain unchanged in the budget. The lifetime allowance, so this is the maximum amount you can have in your pension, was actually increased slightly in the budget in line with inflation. So the limit was £1 million, and that will go up to £1,030,000 from April next year. It is possible to have a higher pension protection amount than this, but anyone who currently is in excess of £1 million and hasn't applied for any protection, it is possible to still protect your pension, potentially up to £1.25 million, by using Fixed Protection 2016 or Individual Protection 2016. Now, it's really very interesting, but I haven't got time to go through the detail today, but if you haven't done that, it really is worth thinking about doing that. The reason being is that when you come to extract money from your pension, if you are above those lifetime allowances, you'll face a 55% tax charge on anything you take out as a lump sum, or an additional 25% income tax. One of the myths I wanted to burst today is a common misconception that, well, I don't want to pay into my pension because, well, if I die, that money disappears with me. Now, that is absolutely not the case. But to be clear, what I'm talking about here is defined contribution pension schemes rather than final salary schemes. And the situation is, if you were to die, quite often the pension may pass between husband and spouse. But let's say both of you were to die in a tragic car accident. That pension pot can pass to the children completely free of any income tax, capital gains tax or inheritance tax if that death occurs prior to the age of 75. And I think it's a massive misconception that paying money into a pension will be lost when you die. The situation does change slightly post the age of 75, and that if death occurs after age 75, again, same situation, both Mr. and Mrs. are no longer here. Money goes to the children. Anything they extract from the pension, they will pay tax on their marginal rate. So whatever their income tax rate is, they will pay income tax at that rate. But again, no capital gains tax and no inheritance tax. So if anyone has been worried about making contributions, thinking that money will disappear, it doesn't. And often now people are almost looking at pensions as a form of trust to benefit children potentially down the line. Now, Faye touched on these allowances earlier, and I'm not going to run through the detail, but I think we're very lucky at Scrutton Bland because we've got a huge interaction between tax and financial planning, and the two really go hand in hand. So when we're looking at running pension portfolios or investment portfolios for clients, we're always looking at the tax implications to make sure things are as efficient as possible. Faye touched on the dividend allowances earlier, and this really has a massive impact when we're looking at maximising the values in investment portfolios. As Faye said, the limit is changing from £5,000 down to £2,000. And what we're illustrating here is that there's a quite dramatic effect that can have dependent on the construction of your portfolio. So as you can see, if you had £500,000 invested, generating a modest 1% yield, well, that was fine. You weren't incurring a tax liability. If you just maintain that balance now, if you get more than £200,000, you're going to be into a taxable position. And one of our jobs as a financial advisor is to look at the construction of a portfolio and say, actually, can we change that investment mix to make sure we're not incurring unnecessary tax liabilities? So for example, typically UK equities will produce a higher yield than perhaps US equities. So looking to rebalance portfolios using annual capital gains tax exemptions, moving it into a position where you're generating less income, therefore generating less tax liabilities down the line. Again, I'm not going to run through the detail on this slide, but as financial advisors, we try and use all your various allowances available. So what this is really illustrating is that we try and fill those various boxes as part of your financial planning. Pensions, clearly a very useful tax tool that I've touched on earlier. ISAs would tend to be our next port of call for clients. Then looking at some of the more esoteric products, being the VCT and EIS investments, which have some fantastic tax reliefs. So back to work. ISAs used to be a very simple product, but with some government tinkering, they've now become rather complicated. The message here really is that there's no dramatic changes to the ISA allowances. Personally, I can't wait for the day when the government decide that they're going to bring in some ISA simplification. Then really we will have an even more confusing situation. I did just want to highlight a couple of points in that the junior ISA allowance has increased slightly to £4,260. And one thing that people often aren't aware of is that previously perhaps children have benefited from child trust funds. It is now possible to transfer those, which were quite restrictive, into ISAs and have a much better investment mix. Again, innovative finance ISAs, there was no great announcements in the budget, but we do see this as something that is going to grow in the future, and we'll keep you abreast of any changes that come into play there. Now, EIS investments. Now, this was a change and some good news in terms of the allowance doubled, as Faye mentioned. So EIS is a fantastic tax planning tool. Our jobs as advisors is not just to look at the tax side, but say, actually, what are we investing in? Do these underlying investments seem sound from an investment point of view? And we are going to see a change in the underlying mix of EIS investments. To date, we've tended to look at opportunities where there is a certain asset backing of those investments. Typically, that has been by way of a property or perhaps a business that has contracted revenue streams. Now, these new opportunities are unlikely to be able to invest in similar types of businesses. Therefore, what we will see is much more opportunities in growth type of businesses. Now, these are likely to be high risk, but then they're likely to produce higher potential returns. The asset-backed solutions are very, very valuable, but they don't produce great amounts of growth, and they're not designed to. So we do see the investment mix very much changing within the EIS environment. And one of the keys to that will be making sure that we've got good diversification across those underlying businesses. And what we anticipate to happen is that you see some businesses that will produce much higher growth rates, but we might see one or two that perhaps don't fare so well. But we shouldn't lose sight of what Faye covered earlier on, that whilst we would never look to be making losses within investments, there are some valuable tax relief that you still can claim. Now, when we sat down after the budget, one of the things we talked about was actually there was a £3 billion promise to support Brexit, but where does it come from? And as Luke mentioned earlier on, when we looked at the detail, that's been funded by selling down £3 billion worth of RBS shares on an annual basis. And this struck a chord with me because when we look at financial planning for clients, it's all very well to set plans in place, but we need to look at how people are managing their assets and how they're going to fund their future objectives. And we call that cash flow modelling. And if you don't plan, then this can happen. You think you're ticking along nicely, you stop working, and suddenly you run out of money. And I'm sure none of us would want that situation. What we'd much rather have is... So the other thing that was that struck a chord with us on the financial planning side is that in Brexit, there's an awful lot of talk of uncertainty about what the future may hold. Now actually, for us as financial planners running investments, uncertainty is just part of our world. It's very, very difficult to predict the future and anticipate what might happen. Now this chart here is illustrating that, and this is looking at the returns in the FTSE All-Share over a 12-month period. And what you can see there is that in every year, there's quite a large variance of where the returns come from. And that's just looking at one market. So trying to predict what the returns are going to be is extremely difficult. Now clearly there are some periods of downturns in there, but most years there's some fairly high peaks and some fairly low troughs. So trying to predict when to invest and timing it is very, very difficult. Now this is just one market, and the way we try to mitigate that risk is by diversification, spreading assets far and wide. And anyone who's seen some of our presentations before might be familiar with this slide. And this slide demonstrates that point very, very well. And what this is showing is that by diversifying assets across different asset classes, you can help smooth out those peaks and troughs. So that nice wiggly line is showing the effects of a spread portfolio, which helps to stop those peaks and troughs to some extent. And my closing statement really is looking at that end column, which is looking at volatility. And that white box at the bottom is the lowest volatility that can be achieved by creating a diverse investment portfolio.